Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. Hi, everybody. Welcome back to the DIY Wealth Canada podcast. I'm Nelson. I'm here with Bob. And today on the show, we are going to talk about 60-40 portfolios. We're going to go over everything from what exactly they are to whether they have a role in today's market in your portfolio and everything in between. And I think more kind of generally, it's going to be a discussion on bonds and kind of the role that bonds play in your portfolio. Bob, are you ready to discuss bonds, the sexiest thing in the history of finance?
For sure. And for the listeners that aren't familiar with 60-40, is essentially 60% in stocks and 40% in fixed income. So historically, that seemed to be the magic mix for the best return versus the lowest risk. So yeah, it's going to be interesting to dive a little bit deeper into whether the 60-40 portfolio still makes sense in today's world or not.
Yeah, I really liked how you've started with kind of that history, because I really want to talk about that history, and because it's quite interesting for me to kind of look back and to see that it was almost decades that kind of 60-40 was the split between stocks and bonds, and that was kind of the standard for a very long time. And I think part of the reason why it was so standard and so accepted was because, of course, interest rates have largely marched down for the last 40 years. We went from super high interest rates in the early 1980s. People have these stories about how they bought Canada's savings bonds and got these 12, 15, even higher percent annual returns on these ultra safe assets. And so back in the day, you could put your money into those assets and do fairly decently in terms of a percentage return each year. And so now that bonds have gone down so much, the yields offered so low that you just can't really get a whole lot of interest in bonds anymore. I think the largest bond ETFs pay about a 3%, of course, dividend, but in reality, it's interest, and interest is taxed at your highest marginal tax rate. So, Bob, I guess my first question is that why would somebody own bonds in today's market when they can only get a 3 to maybe 4% interest rate if you're really kind of feeling frisky, or you lock something in for kind of a long term in GIC? Why would somebody look at having a substantial portion of their portfolio in something like that?
Yeah, I think before we dive into that, we should talk a little bit about history. As I mentioned about the 60-40 mix before, and that really came out of I forgot who it was, but it's the modern portfolio theory that was developed in the 1950s. And Nelson, you were right, like back in the 50s, 60s, or even like during the 80s and 90s, interest rates were super high. I think I read that some of the interest rates back then were like 10, 15%, right? So when you buy bonds, essentially bonds is like an obligation that company have to pay. Like they're basically an IOU where the company said, okay, you could buy say $5,000 worth of bond, and I'm going to give you certain percent yield based on the interest rate today, right? So when interest rates are high, then you obviously could get pretty enticing yield with bonds. Now, in today's world, the interest rates are relatively low in comparison to what we saw in the 80s and 90s. Right today, as Nelson mentioned, interest rates in like 1 to 2%. So bonds, typically you get a yield of 2-3% at best, right? And the idea of bonds, we should talk about it a little bit, is in theory, bond provide some protection against the stock market. So the idea is like bond has an inverse relationship compared to the stock market. What does that mean? That means when the stock market goes up, the bond value goes down. And when stock market goes down, bond market goes up, right? So the idea is you're buying bonds to protect yourself from stock market going down, right? So the 60-40, according to the modern portfolio theory, is probably the best mix from a risk reward point of view. But now with the interest rate being so low, you don't really get much from bonds. And that puts a lot of pressure, especially when you want to, sustain your retirement income for say 10, 20, 30 years, or even more if you decide to retire early. Now, the interesting thing in recent years is, remember I said that bonds and stock market have an inverse relationship? The interesting part was back in 2022, both stocks and bonds fell simultaneously. That rarely happened historically, but for some reason that happened, and stocks fell and bonds also fell, and essentially that theory just went out of just didn't work at all. So that's where it you have to question whether the 60-40 portfolio makes sense or not. And with the interest rates being so low, and I don't see any chance really for the interest to go back up to about 5%. I really see, like, personally, I believe there's very little point buying bonds. Nelson, what are your thoughts?
Well, I think back to the 1950s. You talked about the modern portfolio theory in the 1950s and how that was came up with, and it's interesting because I'm familiar with that because I've read part of the modern portfolio theory is that dividends essentially don't matter, and we won't get into that. That's a different discussion for another day, but that's part of it, and that's why I'm familiar with this kind of the modern portfolio theory in terms of that kind of academic science. But I think it's interesting how a generation of people who came up during the Great Depression and who were impacted by the Great Depression, all of a sudden in the 1950s decide that, hey, we need, everybody needs some bonds in their portfolio and that the 60-40 mix is ideal. And I wonder how much of that, how much the Great Depression and the impact of the Great Depression, the only way that you weren't kind of destroyed in the Great Depression as an investor. I mean, stocks went down 80-90% in the Great Depression. That's how bad it was, is that you had to own bonds. And so that's the argument, as far as I'm concerned, for owning bonds and owning a pretty good part of your portfolio in bonds. This isn't just like taking a little bit of money and putting it in a GIC because you might need it, in a year from two from now. It is a decision that you've made in order to add bonds to your portfolio. So I think that has something to do with it. And so if you're an investor who really worries about the next Great Depression, then by all means, that's the role for bonds in your portfolio. It's almost like a feel good, sleep well at night. So I think that psychological aspect can't be ignored.
Yeah, for sure. And I think it really depends on where you are to your retirement. So if you're near retirement, maybe you allocate a little bit more toward bonds. And bonds isn't everything in terms of fixed income, right? Nelson, you talked about GIC. You could do GIC ladders to kind of protect yourself, provide you some fixed income portion in your portfolio. There's also the cash wedge, right? Essentially, you're holding cash to protect yourself, so you don't have to sell stocks when the market is down. So there are different steps to different methods to protect yourself from market volatility. Now, the other thing to consider with bonds is that the price of bonds is tied directly to interest rates, right? So remember I mentioned a few minutes earlier that bonds are essentially IOUs from government or cities or corporations, right? And they base the yield of the bond on the current interest rates. So when interest rates are low, then obviously the bond yields are low. But then if the interest rate starts rising, then the new bonds that are issued will have to have a higher yield. But what does that happen to the bonds that were issued previously with lower yield. That means the price of those bonds drop, right? So there's an inverse relationship between bond price and the interest rates. So when the interest rate goes up, your bond price goes down, and vice versa. Why did I bring this up? With the current interest rates being so low, right? Potentially, if the Bank of Canada or the Fed decides to raise interest rates, what's going to happen if you hold a large portion of bonds? Those are not going to worth as much. So you're kind of restricted and kind of limited when it comes to protecting yourself with bonds. So that's another point against holding too much bonds in the current environment.
It's a very important point that you bring up because I think that there's a lot of maybe less experienced investors who don't realize that there's a bond market, just like there's a stock market. And, like it's sort of this very broad thing that people talk about. Oh, the bond market is whatever. But so the bond market is this almost opaque kind of over the counter thing where participants sort of trade with each other and is facilitated through banks and brokers. It's not like the stock market. There's no, bond index. There's no really anything like that. So what I'm saying here is that, these bonds, like you said, the price goes up and the price goes down depending on interest rates. So if you own a bond, you have a contract essentially with a company or government that says they're going to pay you this amount of interest for this amount of time. But then the price of that goes up and it goes down versus interest rates. So that means is that you can own this asset that is this incredibly safe, government of Canada bond that the government of Canada has enough money to pay its bills. And so it's this incredibly safe asset, but yet it can move up and down in price without you really doing anything and without the stability of that asset really going away. Again, the government's going to pay their bills. So you have to keep that in mind when you have bonds in your portfolio, is that the price can move. And when the interest rates move pretty wildly, as we saw in 2022, you mentioned that year, because interest rates did move quite a bit that year. And we saw bond prices move quite a bit as well. And the longer bond always moves more than the shorter bond. So you have to keep that in mind when you own bonds as well. And I think I'm going to get your thoughts on this in a minute here, Bob, but I'm a bit of a controversial statement here is that I think for a lot of investors, the fact of owning GICs versus owning bonds is perhaps the better way to do it because you don't have to experience these price swings. And again, these price swings aren't super big unless you have these like very long-term bonds, but you still have these price swings that can make people nervous in a 2022 situation. So what do you think about investors just forget about bonds and just go to the GIC market, which is a lot easier for the average person to understand?
I think you need a bit of both, to be honest. I think that's just go back a little bit, right? So the 60/40, like one thing we forgot to mention earlier is that there's a concept, I can't remember when it was developed, maybe part of the modern portfolio theory, is that you should own the percentage bond you should own in your portfolio equates to your age. So if you're 30 years old, then you should have roughly 70/30. And if you're 40-year-old, you're roughly 60/40. And as you get older and older, you're owning a larger percentage of bonds in your portfolio. Now, obviously, as you own more bonds and like higher percentage bonds in your portfolio, you're kind of giving up that opportunity cost, your inquiry opportunity cost, because obviously bonds don't return as high compared to the stock market, right? So again, with the lower interest rate nowadays, me personally, I think 60/40 is not the way to go. But I think for the most part, if you're, in your 30s, 40s, even 50s, I think 100% in stocks makes sense, as long as you don't invest with money you need in the short term, right? I think we talked about this in another episode where you want to invest with money you don't need for at least the next 5 years. So you could write out the volatility in the stock market. But I do think there's some need to have a little bit of bond or these fixed income portion, right? So bonds is just a small part of the fixed income. The idea is you you would be able to generate income, like predictable income from the fixed income portion of your portfolio. So that could be from bonds because you know how much bonds would yield. It could be from GICs, as Nelson mentioned. Like if you could do GIC ladder, which means you could put say you have $100,000 and you put 20,000 locked in a year GIC, maybe today, and then 3 months from now you put in another 20,000 for a year GIC, and that creates a ladder because with interest rates going up and down, you may be able to lock in attractive rates with these GICs. And the idea is you will have some money coming in with interest scattered throughout the year. Right. So that's something you could set up yourself. And I think that's a lot easier to control versus trying to predict and guess what the bond market would behave in the future. And that's something Nelson you just mentioned, right? Like instead of relying on bonds, rely on GIC ladder that you created yourself. Now, this might sound controversial, and I think Nelson, you probably we could talk about it a little bit. You probably agree with me, is you can almost look at some of these dividend stocks as bond proxy. What do I mean by that? If you look at stocks like dividend stocks like Fortis or even the Canadian banks, they've been paying dividends for so long, and some of them have such long dividend increase streak. It's basically guaranteed that they will continue paying dividends regardless how the market is doing, right? So you're almost could see that as a bond proxy. So instead of dropping 100K in a short-term bond ETF, I use the 100K and buy Fortis, which I think when we're recording, I think it's yielding about 3%, a little bit north of 3%. So that's another way to get that fixed income portion of your portfolio. Nelson, your thoughts on that?
I completely agree with what you're saying there about these bond proxy stocks, and I've spent maybe not a lot of time, but I've spent time studying this because one of the things that I was looking for when I would research individual stocks to buy is kind of how did this company handle 2008, or how did this sector handle 2008, and looking at that as kind of this worst case scenario of what would happen to the dividend and what would happen to the stock price and everything. And so what I discovered is that in 2008 there was a lot of people that would hide in these boring kind of sectors, and so the likes of Fortis did quite well compared to the rest of the market. They did not go up, they did fall, but they outperformed the rest of the market pretty substantially. Canada's grocery stocks, they outperform substantially. Utilities, like I said, not really REITs, because normally REITs do well when interest rates are falling, which happened during that time. But the worry was that the issues in the economy would impact these companies' ability to pay rent. So essentially what you have is you have these assets that are not really correlated to the rest of the stock market, even though they trade on the exact same stock market as everything else. And you can use these assets as a investor to kind of de-risk the rest of your portfolio. So absolutely, I think that there's some logic in that. And that's part of the reason why, for me, my portfolio is so boring and was intentionally built to be boring, is because I like that relationship. I will say there is one negative to this strategy that I've seen, and I did kind of touch on it, where bonds in a 2008, 2009 bear market, and like those types of markets, bonds will go up. And so what that will do is it either creates like it lessens the loss for you, or it creates this asset that has kind of gone up that you can then sell and then put into equities as the stock market is very cheap. So it's kind of this sort of this cash position, almost like a cash position that you can use and you can sell to put the cash to work in cheap stocks. So that's kind of my next question, Bob, is that's from my perspective, I think that's a big advantage to bonds is that you have this cash you can, or this near cash asset that you can sell and then put to work. Market is fallen. What do you think, is that like a big advantage for bonds, or are you okay with just foregoing that in your portfolio?
Yeah, for sure. I think again, it depends on where you are at in terms of your investing journey. If you're still working, you're getting full-time income every 2 weeks, a paycheck where you could save and then invest in the market. Maybe it doesn't make that much sense owning that much high percentage of bonds. I would say if you're working full-time, you're probably better off doing 100% in stocks. Now that all really depends how you are personally, but for us, I think it's worth the risk. Now, if you're closer to retirement and you're retire, I think again, I think the 60-40 split doesn't make sense in today's world. I think if you're near retirement or retired, maybe an 80-20 portfolio makes sense. Now, as you get older, maybe you're in your 70s or 80s, maybe that's when 60-40 may make sense, or even 70-30. But for the most part, I think I would try to minimize the fixed income portion. I think the most that we probably would get to is probably 80-20, and the 20% not meaning everything bonds, but like cash and GICs and other reserves, right? And Nelson, you're right. The whole idea of bonds is, whatever the mix you have, 60-40, 70-30, 80-20, is that you want to rebalance your portfolio. So if you're not adding any money into your portfolio and you're constantly maintaining, say, this 60-40 portion, the idea is that if the stock market goes down, you would rebalance your portfolio to maintain that 60-40. And as the stock market goes down, in theory, the bonds should go up, and that creates that extra money that Nelson was talking about earlier, such that you can sell some portion of your bonds to buy stocks to maintain the 60-40 portfolio. But I think that's really when you're in retirement, where you're not injecting new cash into your portfolio. When you're still working and you're saving, you're investing regularly, I think you're better off kind of hold a little bit more on the equity side, because you have that constant inflow of money to take advantage of any stock market volatility rather than relying on the bonds portion.
Yeah, one of the things I think has affected our thinking in terms of, I'm talking kind of everyone's thinking, because I think we're pretty consensus on the kind of no bonds or very few bonds kind of attitude. And we've talked about this, where it's like the interest rates you get from them just aren't very good. They don't really move the needle. And you're basically just putting this money in this asset class that only does well when stocks fall. Now, we're in year basically 15 or 16 of an almost relentless bull market. I mean, from the end of 2009 all the way to 2025 here, where when we're recording this, is stocks have just marched higher and higher and higher relentlessly, and just really haven't stopped. Yeah, there's been a few, 2013, no, 2012, I think it was that the first government shutdown. I think there was a pretty good bear market then. I think we were down 20%. 2018, I remember that. And then, of course, 2020 and 2022. So we've had a few sort of short kind of bear markets, but not really anything that's just been nasty. They've just kind of been, they happened and they slowly went away. So, Bob, my question is that, do you think that we've kind of lulled ourselves into a bit of a false sense of security because stocks have done so well for so long? And if so, wouldn't today be the time to maybe look at a 60-40 portfolio again, or something to that effect, just because we could be due for a correction? And obviously, I don't know when we're going to have a correction, but, so what do you think about that? Do you think it's prudent nowadays to be a little bit more cautious, or is that market timing? Then we don't want that.
Yeah, I think a bit of both. I think obviously you always have to be a little bit cautious of the market and market volatility. And and what you could stomach is going to vary person by person, and it really depends on your personal scenario, and ultimately that comes down to your savings rate and how much you're spending kind of month over month. But I think I thought about that, what you're talking about, Nelson, the duration of these bull markets that we have seen in the last, I don't know, like 15, 20 years, or well, actually less than that. And also the duration of these bear markets we're seeing, as you pointed out earlier. Does it make sense to go towards 60/40? I personally think not. I still think that maintaining a large portion of your portfolio in the equity market makes sense, just so you're not giving out that opportunity cost. But I do think there are many ways to protect yourselves from potential market correction. So you have some cash sitting on the side, ready to deploy, and so on, right? And having relatively high savings rate will help as well, and having like if you're still working, that income coming in will definitely help a little bit as well. Where I'm trying to get to is that I think in today's world, and I think I may have talked about it or written about it on my either on this podcast or on my blog, is in today's world, the dynamics of the stock market has changed, right? So if you look back, say the financial crisis back then, that was very, very different than today. Like today, you could trade stocks pretty easily with Wealthsimple in Canada, Questrade in Canada, in the US, I think Robinhood and all that sorts. You could quickly trade, and you could move your money in and out of your account relatively quickly. So when there's a big drop in the stock market, a lot of people take advantage of that by quickly moving their savings over to buy stocks, or invest into the stock market and take the opportunity when there's a 10, 15, 20% drop. And I believe, again, I don't have any academic research behind this, but my personal belief is because the way technology has evolved and the way these trading platforms have evolved, it changes how quickly or how short these bear markets will last. Because you will see a big inject of fresh equity or fresh capital into the market, and that kind of dampens the duration or shorten the duration of the bear market. So that's one. Now, will we see a prolonged bear market? I don't know, but that's where there are many different ways you could protect yourself from that. Like holding some cash, holding a little bit of bonds. I don't think holding too much bonds again make any sense, especially in the low interest rate environment. But yeah, I still don't think 60/40 makes sense. Again, as I mentioned, probably at most we would go with the 80/20. But you could ask me again in 5, 10 years, maybe I'll change my mind, because obviously the market is very dynamic, so things could change. Nelson, what about you? What are your thoughts about these really short bear markets nowadays we're seeing?
It is a little weird to see. I think social media has an impact on this as well. We talked about social media a couple episodes ago, and the kind of the positives and the negatives of that. I think one of the, I don't know if it's a positive or a negative at this point, but it's fascinating to watch these bear markets happen in real time on social media, because you get the people who are the most leveraged and the most exposed to the high beta, the riskiest stocks with the most volatility. And of course, they freak out and they talk about how they're broke, and they share their screenshots and whatever. And like that's a very big extreme sort of in one direction in terms of building your portfolio, having the riskiest assets all under one account. Those things are going to bound to happen. Where, as we talked about earlier, if you hold more boring stuff and you don't have these risky assets, or just very few of these risky assets, then it's not really as big of a deal if the market goes down, because you have these non-correlated assets like I talked about earlier. So it really comes down to the risk that you have in your portfolio, and kind of prepping for a bear market before a bear market actually comes. And I think that comes down to just sort of playing defense, where you think about, okay, I understand the upside of this. So what about the downside? And my view is that if the downside on something is significant, then I really don't want to own it. And maybe it's because I'm in my 40s now, and this is kind of my mental 60-40 portfolio of, these boring assets rather than these get rich quick, exciting, it could double or it could have sort of assets. So I think that, yeah, like getting back to what we were saying before, the types of assets you own, those matter, and you can get almost like a similar risk to a 60-40 portfolio just by concentrating your efforts on the more boring sectors of the stock market.
Yeah, for sure. And I think, again, personal finance is very personal, and investing is part of personal finance. So it's a very personal decision, and what works for you, Nelson, probably may not 100% work for me, and vice versa. What works for us may not work for you or listeners that are listening. So it's about developing a strategy that works for your own personal circumstances. And going back to this topic of 60-40, it's all about risk management, right? The whole idea of owning 40% in bonds or fixed income is to manage your risk, right? So when the market drops, you still have that 40% in your portfolio that's relatively stable. Now, obviously, that really depends on if are you more risk averse or are you not, or what's your personal situation, right? Are you is your house paid off? Do you still have a large portion of monthly expenses that will increase, right? Mortgage payments, car loan, etc. All these play into how you construct your investment portfolio, right? So if you have like car loans and you have mortgage payments and other debt like credit card debt and stuff like that, you probably want to, play a little bit safer. Or that's what I would do personally. Some people may think, oh, because they have so much debt, they would put all their money on high risk investments so they could gain more money quickly. But again, that's a personal preference. But I think you really need to look at your investment portfolio, your money holistically, right? Like what's your personal situation, and make up a holistic investment strategy that suits well for your own personal circumstances. So, and I think that that's what's important, and you need to do something that allow you to sleep well at night, right? Just because you follow some investment guru on the internet doesn't mean that suits well for your own personal style, right? So it's just like everything in life. Just because somebody says, you should exercise this way and that way, may not be the perfect routine for you. So you kind of have to develop your own routine, right? It's the same for investment.
Yeah, I definitely agree with that. And the one thing I'll add is that if you have high interest rate debt, you maybe shouldn't actually be investing. You should just worry about paying down that debt. And there's a Charlie Munger quote about how him and Warren Buffett got ahead because they were just consistently worried about not being stupid rather than making the optimal choice all the time. And I think that the paying off debt is just that's the equivalent of not being stupid. It's a guaranteed return. Just take it. And now that if that debt is a mortgage, well, that's a completely different ball game, and there's kind of reasons why you might pay that off or not pay that off that we won't get into. But let me ask you this, Bob, pivot into something slightly different here. Is that in terms of bonds in someone's portfolio? Okay, so you've decided that you like the 60-40 portfolio or 70-30 or whatever, and then it's time to pick some bonds to put in that portfolio. Now, the temptation is to sort of stretch and define some of these kind of funky bond products that are out there that promise much higher yields. I don't know if you've paid any attention to this part of the market. Maybe not, because you don't have any bonds in your portfolio, and I don't have any bonds in my portfolio either, but I do pay a little bit of attention because I get people asking me about stuff. And there are bond funds out there that are paying, 4, 5, 6%, some are even higher on just like kind of these wonky sort of strategies. And in the US, these are very common, are these closed-end bond funds that invest in high yield bonds, junk bonds. The historical people who were alive in the 1980s remember junk bonds. The kids listening probably don't. But these are these like kind of higher interest bonds issued by companies with dicier prospects that pay anywhere from kind of 6% to 12%. And then these funds use leverage on top of that to really increase the returns. And a lot of these guys offer double digit yields. So, Bob, are you familiar with any of these? And if, if not, just maybe, what do you think of the whole stretching for yield in terms of bonds, which are supposed to be the safe part of your portfolio?
Yeah, I mean, we do own a little bit of bonds in my work's RSP, just because through my employer, we're supposed to do our risk assessment and like up and down a little bit of bonds. But yeah, I pay a little bit attention in the bonds sector, maybe not as much as you, Nelson. But yeah, I think I didn't know there's some leverage bond ETFs out there. That's just absolutely insane, in my opinion. I think the whole idea of bonds, again, it's about safe investment, right? It's the safe portion of your portfolio. So taking on more risk to get higher yield doesn't jive with me. And you kind of have to look at bond, just like your equities portion bond. You could build your bonds various way, right? So there's like short-term bonds, there's long-term bonds, right? And then Nelson, you talk about these junk bonds. Like typically, bonds are the safest are from the government, right? The federal government, like the Canada or the US, right? Where there's very, very low risk of these bonds defaulting. And then there's also like provincial bonds and municipal bonds. Those are relatively safe as well. And then you could get into like corporate bonds where corporations issue bonds, and typically those provide a little bit higher yield compared to your government bonds. But obviously corporates they could go bankrupt. So there's a little bit of higher risk there. But so you buy like big corporation bonds, right? But then there's junk bonds where it's from like, tiny companies that you don't really know much about it. And then there's these credit ratings that you need to consider when you look at corporate bonds, right? There's like AAA, AA, single A, triple B, etc. So that kind of gives you an idea what the likelihood of these companies going bankrupt or the bonds defaulting, meaning you won't get paid for your IOUs. So I think constructing your bonds portion in your portfolio, it really depends your risk factor, right? So I think you need to have a bit of both long-term and short-term bonds just to protect yourself from the interest rates moving around, right? And then you probably want to have a little bit portion of both government and corporate bonds just to increase that yield a tiny little bit. But I would not go into like these leverage or junk bonds, because I mean the whole idea behind bonds is you want a safe haven to protect yourself. So why take on additional risk by going these like double digit bonds? That just doesn't make any sense to me.
Yeah, I agree 100%. It's like, you're taking equity risk on a asset that's supposed to be safe. It just doesn't make any sense. And it's just another situation of stretching for yield. And that often ends in tears. Yeah, sometimes it works out, sometimes it doesn't. I will say that in terms of the bond universe, when I have held bonds, sometimes I will put some money in there as kind of a cash equivalent. I did that before the cash ETF was really a thing. The ones I would use is ZAG, which is the BMO Bond Universe ETF. And then there's XBB, which is the iShares one. My understanding is they're very, very similar. They both own something like 1,500 different bond issues, and it's everything from governments to corporate. And then they cut off at a certain point in corporate bonds. So they only pick the best corporate bonds. So that would be kind of the one that I would maybe not recommend, because I don't recommend anything. I'm just a guy talking here on a podcast. But like we said, it's important to keep more conservative. So Bob, we're almost out of time, but I do want to talk on one more issue with this, is that do you think preferred shares are a bond substitute? And people like preferred shares. Dividend investors especially like preferred shares because preferred shares pay dividends and dividends are taxed attractively. So what do you think of preferred shares as a bond substitute?
Oh yeah, absolutely. I think that that's definitely something investors could look into, preferred share. And typically preferred share has a deadline, right? It's just similar to bonds. And so you're kind of held a certain time period. And preferred share typically provide a little bit higher yield than bonds. And the way preferred shares are set up is that companies are obligated to pay distribution to preferred shares first before they pay distribution to the common shares, right? So if you're Royal Bank and you have preferred share A and then you have your common share, Royal Bank will have to pay dividends or distribution to the preferred share A first before they pay the common share. So yeah, in that sense, you're kind of a little bit protected, even there's just that obligation, right? Because by law they have to pay out the preferred share distribution. So I think that makes sense. So maybe a mix of both bonds and preferred shares. Again, there's so many different ways to construct your investment portfolio. So that ultimately is it's your choice and how you want to construct it and what you're comfortable with. So yeah, I think there's definitely a place in preferred share, and you could definitely construct it by a combination of preferred share and common dividend shares.
Yeah, I'll quickly add that if you're a individual stock picker, I think preferred shares are every 2 to 3 to 5 years. It kind of depends on the cycles or whatever, but what you'll find is that the preferred share market will go up and down probably more than what bonds do, which is attractive if you can buy preferred shares when they're low and then kind of sell them when they're high. I was active in the preferred share market in 2023. I thought there were some really good deals out there. And I've since sold those. In fact, I sold them, I think, less than a year after I bought. I had a nice capital gain almost immediately, maybe not immediately, but very quickly in terms of the preferred share market really moved in my favor there. So I would just say that my experience, what I do is that I buy individual preferred shares rather than the preferred share ETF. I think that you can find better opportunities that way. But, and this is a big caveat here, folks, is that it is a complicated market that I I spend a lot of time reading it and understanding it and et cetera to get my understanding of it high. And it's not something you want to dive into in terms of you're just, oh, I think it's a good idea to go look at some preferred shares. You'll quickly get lost in the lingo and et cetera. And so at that point, ETFs make the most sense. It's just keep in mind that you will see these big swings and that you want to, you don't buy when things are good in the preferred share market. You want to look at it when things aren't so good. So I think that's about it today. Bob, any last thoughts before we let everyone go to work or wherever they're heading today?
I just want to say 100% agree with you on that preferred share side of things. It's very complicated when it comes to preferred share. So you're probably better off relying on preferred share ETFs rather than individual preferred shares. And yeah, I think this topic is quite interesting, 60/40 portfolio, whether that makes sense or not. So I'm sure we could spend more time talking more about it in the future, but I hope everybody enjoy the episode. And if you do enjoy the DIY Wealth Canada podcast, please give us a thumbs up in the platform that you're listening to, and feel free to contact us via our blogs or leave a comment in the platform so we could see whether you like our podcast or not, or give us some feedback. We would appreciate that.
Absolutely. And thanks everyone for listening. We'll see you next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.